G'day, Money Miners. The boys are back in the flesh. Welcome back, gentlemen, from your African safari.
Thanks for holding the fort, Matty.
Thanks, Matty. Great time. Oh, mate, give us the quick before we get into today's yarn with Tommy Solomon from Parlour Investments. Give us a bit of an Indaba recap, the highlights. What did you see?
Mate, we saw a lot, not just Indaba, but we went to a bunch of operations in the Rustenburg area on the western limb of the Bushfield complex in the week before. And then we went to the DRC for about the week after the conference too. So it was awesome. The mining industry is way bigger than you think just here in Perth. There was some big characters, people from all over, from London, Middle East, and the sorts of characters that don't necessarily come to Diggers and Dealers that you see at Indaba, which was pretty eye-opening.
Felt like we're in a pretty small bubble here, Matty, after going there. But super keen to bring some of the conversations and content that we had over there to the money miners over the following weeks.
Sensational.
Yeah. I think we trebled the amount of mines we've actually been to, which is awesome. We're getting close to your numbers, Matty. So that was awesome. And yeah, there's a lot of people we're very grateful and thankful for that over time. We'll hopefully pay it back for hosting us, for making our life very easy.
Handed over a bit of cash, true African style, are you, JD?
None of that, mate.
No.
In kind.
Oh, so right, tell us about your first cab off the rank for one of the Indaba interviews or African interviews you did.
So we managed to pin down Tommy Solomon, who works at Parlour Investments, for a good half an hour, and we covered a lot of ground in this chat. Uranium, copper, gold. Macro's got a great sort of lens with which he views the world, as well as a few quick takes on some other commodities as well. For those that don't know, Parlour is Swiss-based. Tommy runs the public equities side of their portfolio. They're active on a few different fronts, but he does all public equities.
Long, short.
Yeah, long, short. They are mining, natural resources focused. So not a big generalist or something like that. Very into the nitty-gritty of mining. So it was an awesome chat, and in time we'll get him on for a deep dive where we'll take about a couple of hours of his time, I reckon.
A bit of stuff in here I might like, eh?
I think so, man.
The word uranium was mentioned once or twice.
Oh, very good.
It was a cracker, and he was across it the whole world as well, knew the ASX inside out, but had great views on Europe, North American names and everything.
Very good. Did you tell him about Grounded's new website while you were yarning?
He already knew about it.
He's probably flicking through groundedgroup.com.au. You just look at the bloody ship flying around everywhere. Check out the portfolio. The project portfolio we've been talking about for frickin' ages, boys. Look at this. Rockley, Rio Tinto. Jerrawar, Rio Tinto. Katabi for Iluka. Club Hamilton for Fortescue. That place sounds cool. The list goes on. Go check out the sexiness of the Grounded Group and just talk to them about making your mine site sexier.
100%. This is luxury.
Mate,
and it doesn't come at a luxury price tag.
They don't build shit.
That's it. Look after your employees. Do the right
people.
thing.
Get the right people.
Get
a grounded village.
Good slogan.
JD live from Indaba again, and here with us we've got Tom Solomon from Parlour Investments, another fellow Australian, but you don't spend too much time in Australia yourself. Tom, thank you so much for making the time to join us and talk about all the things that sort of matter in the investment landscape for the mining stocks today.
It's a pleasure, guys. Great to be on this for the first time, and my first stop here at Indaba, so words of wisdom to come.
First of many, hopefully. So let's get straight into it. I want to talk about uranium. Obviously, you're in this beautiful continent now, and you're going to tack on some sort of site visits, but what's the sort of temperature gauge from the uranium market more broadly? We had some interesting quarterly results for the Aussie names, and we spoke before we started recording about a bit of a dislocation with the North American names and the Aussie names. How are you feeling about the narrative?
Yeah, I suppose if we look back to last year, and especially sort of coming into year end and the second half, clearly huge dislocation as the North Americans rallied on data center news, small modular reactor news, and a lot of the Magnificent Seven talking about this demand drive to come. Clearly the Australian names, which had run much harder earlier in the year, and maybe the Aussies were earlier into the cycle than the North Americans, clearly had further to fall, but definitely did not get a bid. Paladin's miss, I would say, to put it lightly, on expectations, definitely added fuel to the fire on that allocation away from uranium in Australia. With Parlour's investment process, though, we're we do try to take maybe a little bit more longer term and really do the deep dive into these niche commodities. And I'd say uranium is still on the niche when it comes to that. Look, clearly we were constructive at $20 a pound, but actually I'm more constructive now than when we were at 20. And the main reason for that is this period of consolidation hasn't changed the fundamentals. To me, SMRs are not impacting in any way, shape or form our supply, a significant demand driver for the next 5, I'd say at least 10 years. The demand driver of this is China. And it's building new reactors, doing 3 times an initial loading when you start up a reactor, as well as building inventory levels. As people look at global inventory levels, to me that's a misnomer. Because actually, yes, China's got high inventories. That's not coming to the market. US or North American and European utilities are at 2 years of inventories, and they've been depleting them quite significantly. The Sprott Physical Trust, those tons are not coming to the market. So as we look through this, the market is extremely tight from this historic sort of supply from different sectors or different areas that have historically come to ruin the party, whether that be post sort of Fukushima or most recently Western destocking. But the Chinese are coming through, and when the Chinese say they're going to do something, we've seen it in iron ore, we've seen it in lithium, when the Chinese go from your apparent consumption of below 20% to nearly 40% in the next 8 years, I think that's going to change the market. And so that's one thing. Now, I'm clearly not calling this next iron ore, but I do think that demand driver is something to watch. I then also touched on a bifurcation of supply chains. Clearly the Russian bans, we've had some waivers coming in, but I don't believe that, I believe that these bans had actual bipartisan support in the US. And even if Trump wanted to on a potential resolution to the Ukraine conflict, I'm not sure that he could actually get something through. Either way, if you're a Western utility, you can't be contracting out 3 years for some Russian supply, and something could very likely change in that time frame where therefore you are then caught short of your required demand, of your required consumption. So because of that, I actually think it's going to be self-imposed by the utilities. And so if we look at the low inventory levels, meaning that they do need to contract, we saw Q4, the highest contracting quarter in quite a few years. Term price moved up, yet the lowest spot market activity in quite a few quarters. That was weighed. The spot market is a very small part of the market, and it's the tail wagging the dog here. But on that bifurcation of supply chains, what is really underappreciated is the overfeeding when it comes to the limited enrichment capacity available to the West. On our numbers, that's nearly going to have a 20 million pound delta over the next few years, where historically we've been underfeeding the enrichment capacity. Now, due to the limited capacity available to the West, and we are trying to build more, but we're going to literally switch from a sort of 5 to 10 million underfeeding to 5 to 10 million overfeeding requirement. To me, all of these factors lead to quite a tight market.
Is that a per annum number you're talking about there?
Yes, so a per annum number. Clearly the data, trying to model uranium is, I'd say, one of the hardest things I've ever done. It's a real black box, and especially when you talk about trying to get data out of China or understand the inventory levels there.
Yeah, capital cycles and resource companies being very prominent in how cyclical they are, notoriously difficult to model demand, supply. Do you really come at it from the perspective of having a foundation in the supply narrative, understanding that much better, because the demand side of it seems to fluctuate. Data centers are super hot, they've been hot for a while, and then DeepSeek, yada yada, they're not quite as hot. Do you have your sort of foundation of confidence in the supply side? Is that how you kind of think about it?
So yes, we definitely do think about it that way. I think all of these factors, though, are different durations. So from a demand side, we know the base load reactor requirements. However, demand and consumption in uranium are two very different things because of the high inventory levels and the ability to draw or build those inventories. Data centers, to me, are much more long duration trade, especially SMRs, how they're going to be implemented. My views differ from other people in the market, but it doesn't matter near term. For the next 5 years to 2030, that's really where we're looking to model out. You've got a much greater clarity on the supply, and that's going to have sort of the bigger delta. Clearly, you've seen mines in Niger being taken away from Irano and Western producers. You've seen mines in Kazakhstan historically that were tied to Russia, going into Russia, now going to China. So a lot of the growth in Kazakhstan is coming from China. The black box is understanding if Kazatomprom can actually get the sulfuric acid issues under control and ramp up. They're building their own plant, but over the next few years, it's still uncertain. But for me, the big swing factors driving the near-term uranium price is the secondary supply. So that is strategic stockpiles. I believe the DOE has released what they can. Then you talk about the over-under feeding of enrichment, which I've spoken about. But then you look at commercial inventories. You saw Western commercial and financial inventories, release 30 to 40 million pounds a year per year over the last sort of 5 years. It's clearly fluctuated quite significantly. A lot of that excess supply that came was taken up by the financial purchasers, so the likes of Sprott. These are the factors, these huge swing factors, which could be 50 million pounds in a 200 million pound market, which can really impact near-term prices.
The other part of the supply there is Kazatomprom, who in the latest reporting didn't reference the word sulfuric acid and may be surprised with some of their forward-looking guidance and production capability. Are you paying close attention to that, or are you relatively confident that their supply challenges aren't over?
I have to admit, each month I change my view on what I think of Kazatomprom. We've tried to stay quite close to this. I think you've got two things. There are clearly operational challenges and sulfuric acid shortages. Now, there is sufficient sulfuric acid in country, but clearly a lot of it's going to agriculture and elsewhere. How much can they take? They could also purchase a lot more. They are the bottom end of the cost curve. It's not necessarily going to alter that much. The other point which some people are talking about is, look, they're actually, some of the wells we've got at the moment have sort of been depleting a bit. Actually, they're conserving the sulfuric acid for bringing on this new production, saving the remaining sort of tons in the ground for the higher prices. All in all, I feel like it comes back to a political understanding of what's going on in country. Now, we can talk about that the Kazakhs say openly that no, they want to supply both the West as well as China and Russia. But clearly a lot of the newest asset that they're bringing on, those tons offtake is over to Russia. And I have to admit, I'm quite confused about what is the actual strategic diplomatic plan which the Kazakhs have.
One more on uranium, Tom. The sort of group of uranium miners and developers on the ASX are up there with the most shorted names on the exchange. What do you sort of make of that trend?
As we all well know, commodity investment is highly cyclical. The commodities themselves are cyclical, but the sentiment towards them can change even faster than that. So if I look through, clearly I've shown that I'm quite constructive on the uranium complex. I think where I want to be positioned is until the Rook mine comes in, call it 2030, but clearly there's leeway maybe a bit before, probably a bit later if someone else buys them, redoes the buying plan. The market's tight. Therefore, I want exposure to companies which are not contracted out at fixed prices that are lower than where they currently are, or even at current prices. I want upside exposure to the commodity price and near-term production. So for me, there's only really a few names. Paladin and Boss, clearly at the front there. Encore Energy in the US is also one. But really, when I think about it, the market has clearly been quite short. I mean, Boss, I think, is now over 20% short interest. Paladin just below that. Clearly, both companies' balance sheet is fine. Paladin, especially post the fission transaction, they got 140 million of Canadian to shore up the balance sheet, not that it needed to. Previous quarter was free cash flow positive. We now look to Boss. Clearly the ramp up's going all right. So I struggle to see any balance sheet issues coming up. So clearly it must be a view on the commodity. Now, if it's a view on the commodity, there are a lot other names which I find much more expensive that I'd rather short here. So the risk reward as these shorts have to cover, I think looks quite nice.
Now, our mutual friend Tom Warwick has dobbed you in for being quite good on gold, copper, and macro. I understand your time with us is short, so how are you thinking about those three very broad topics at the moment, Tom?
It's a very favourable comment from Tom, so I'll take that. Clearly investing in commodities, you need to understand the macro and how that impacts our fundamental bottom-up view on the supply and demand of these commodities. Also understanding the flow and the investment dollars coming into our sector. So if I think about the two commodities which you've touched on, gold and copper, firstly on gold, clearly this is more of a currency out of any commodity which we cover. And to me, the main driver here, you've either got fear in the developed markets or greed in the emerging markets. Last year, it was that greed in the emerging markets, firstly by the Chinese central bank, secondly Chinese retail, which really pushed gold in the first half of the year. We're now starting to see that fear factor come through, and that fear factor is more driven by your real rates. And so when we actually look at it, the dislocation of gold to rates last year was quite astonishing. Emerging markets made up for it. As we go forward from here, I do think that medium-term thematic of de-dollarization, of actually getting off US dollar for a lot of the reserves of these emerging markets will continue, especially Chinese consumers clearly being sort of hesitant on the renminbi devaluing, so that continues. I do think maybe we've seen a sharp rise here on this importing into the US due to potential near-term shortages, due to ideas of trade restrictions or tariffs coming in. So I think that could unwind maybe from this overinflated levels, but I think we definitely do grind higher to above that 3,000 US an ounce mark. So gold, definitely quite constructive, clearly a bumpy ride as usual. When it comes to the equities, a lot of these equities, you've now actually getting back into a scenario where there's over 20% free cash flow yield. This is nice. You can stick with those free cash flowing names, benefiting from the lower Australian dollar or the lower currencies elsewhere in the world. And clearly the risk profile, a lot of people, and I know we're out in Indaba here, but clearly after what's going on in Mali, Mozambique and elsewhere, a lot of people are very hesitant to put their money to work there. So,
But before you jump into copper there, Tom, I'm keen to ask a kind of specific one on the hedging practices of a lot of the gold miners out there. You're seeing this big trend, people buying back the book, clearing that liability as it kind of were. Is that a trend that you think is pro-cyclical and bad for the safety of the business, or is that one that you're pretty supportive of because the free cash flow generation is better over time?
So look, if you chat to 20 different investors, you get 20 different answers when it comes to hedging, shareholder return policies and the like. I tend to think the majority of people own gold miners for their leverage to the gold price, whether that operational or financial leverage. In which case, I think that the majority would not like them to hedge. Now, I believe that they can hedge if you're going through a ramp up of a mine or a particular area of high risk, to hedge that 12, 24 month period. Perfectly fine with that. I think a long-term strategy of hedging gold, I mean, people talk about zero cost. It's not necessarily zero cost.
A CRE insurance review of your existing policies is zero cost. We have offered that before. It is still on the table, and you can even pop into their office in Orange.
New office.
New South Wales to get one of these, mate. They are all those Cobar hopefuls, anyone around Cadia, bloody Lake Cowell for Evos. Mate, if you get a mention on the show if you spot a CRE insurance person in Western New South Wales. Ring it in, we'll give you a mention. Keep on the lookout for the CRE insurance crew. Bloody, mate, anything about insurance broking for mining, and I'm talking any mining, construction, renewables, oil and gas.
Mining services as well.
Mining services.
Hedging might be debatable, Matty, whether you do it or whether you don't. Insurance is not debatable. You've got to do it, and you've got to do it with CRE insurance.
And it's mandatory to do the insurance and to do it with CRE.
It's
mandatory hedging.
I'll just say we weren't going to get travel insurance until we spoke with Adam.
We let everyone know that too. So use probably wouldn't be alive if it wasn't for CRE.
I think it's safe to say.
Thank you very much.
Go CRE.
So I personally don't think if the gold miners think that they can trade gold better than anyone else, then become a gold trader. But actually, you can hedge the operational risk, but otherwise I'd say stay unhedged.
Let's continue on with copper then. What's the thoughts on the red metal that a lot of people in this conference are pretty constructive on?
So copper, clearly the bellwether commodity for commodities. It has been there. Copper also is now going through a bit of a flux, I would say, where just as with iron ore, China has been the main driver of the demand side of this commodity for as long as since really before the GFC. That is slightly changing now, where people are trying to say, well, yes, China's a bit weak now. We personally think, look, China isn't great right now. We need to see what the policy response will be before we can take a proper view on where China leads from here. But clearly that policy response is not necessarily going to be property driven. So housing starts may not come through, but completions coming through is still positive for copper. But people are now turning their attention to infrastructure build out or the build out within the developed world, and particularly the US. And so if we think about that commodity build out there, clearly that's a longer duration trade, and again leads back to policy, which, as we've seen over the last sort of week or so since Trump's been in office, that policy can fluctuate quite significantly. So I hate trying to call politics because I'm never going to get it wrong. I love talking about it, but very difficult to therefore make a call either way. But I do think from the demand side, we need to talk about two different trades. There's the energy transition, which is a long duration trade, and that is continuing underneath, despite the recent backlash against wokeism or other terms for the like. But then there's the other sort of shorter duration trade, which is a security of supply. And the Western world is now really understanding that. And you've seen Trump do that. So I do think we start to see more incentives for domestic production or production within friendly countries or friendshoring. But clearly, I don't think at the moment, I'm not calling for a price dislocation for Western supply versus elsewhere. But that trade and actually understanding where that near-term demand is coming from, I think is crucial. The main point which people talk about on copper is the copper supply cliff. There's been a copper supply cliff 3 years out from my entire career, I would say. Now, I'm not saying it's not coming, and we need a lot more copper, and you look at what BHP's put out, and it's some amazing research. Clearly, to develop Escondida, the high capex for a brownfield project, and you look at that compared to a greenfield, clearly we need higher copper prices. Now, the question is, the market at the moment is rewarding companies for shareholder returns and not expansion. This takes us all the way back to sort of previous cycles. We've been in this sort of shareholder return landscape for quite some time. It's only at the point when the investors will start rewarding for growth that I think that starts to change. And clearly price in the medium term will actually solve that. So I don't necessarily believe that there's a copper supply cliff, but copper prices do need to come on to incentivize higher supply.
Last one for you, Tom. We're going to have to invite you back to go in deeper into some of these topics and others for a future chat. But what's your most non-consensus view on the mining investment landscape right now?
Well, given the short interest in uranium names, I'd have to say uranium here. The other one is, we've touched on that clearly mining commodities and the equities tend to be mean reverting. And it's all about understanding, as you've touched on, where there is a lack of supply coming through, but demand is coming. So I suppose another commodity which I quite like is met coal. We're now down at 190. We're definitely starting to be in the cost curve here. Some of the US mines we've started to see come offline. Clearly, the Indians were supposed to come back last year post a delayed monsoon to buy, and that didn't quite eventuate. After Chinese New Year, maybe they step back in and the Indians do need to come back. But if I look through, I don't know where any new supply is coming from. And Indian demand is coming. I know it's always been a jam tomorrow story with India, but that is coming. People then also talk about China and the Mongolian supply ramping up from sort of 40 to 80 million tons. Either way, that is displacing lower quality Chinese material, which is depleting, and therefore they continue to need to hit the seaborne market for blending purposes. So if I look through, yes, Chinese seaborne demand maybe comes down, but it's staying 10 to 20 million tons. India ramps up, no more supply. So maybe not near term, maybe we bounce, but over the next few years, yes, I do believe we're going higher. And let's not forget, Glencore now controls a lot of met coal. Those boys are pretty good managing markets, I'd say.
There are two things that, like, I love met coal, love the thesis. I'm with you on the trade, but the side of things that, you know, I'm looking at that, you know, contradict that is I think there was an approval recently for Mongolia to now be to upgrade the rail to be capable of sending 120 million tons to China instead of 80, which would further, like, if and when that all happens, would further displace more seaborne tons from the market. And then on the India side, I see JCX kind of sign, like basically looking to enter agreements with Mongolian coal producers as well, where they could, you know, get the tons cheaper than they would from Australia and the likes in the seaborne market. So those kind of factors, are you thinking about as real limitations to the bull thesis here?
You've hit the nail on the head. Those are the two big risks, and something we're still looking into. We're not quite all in on these trades as yet. The Mongolian supply, clearly some people even model it and they just put it in seaborne supply. It's not seaborne supply. You look where the country is, and it's coal, same as iron ore. This is a logistics game. So our understanding so far, though, is that you need to look at the quality of both the Mongolian supply, but as well as the Chinese supply, which is depleting. You then understand what the Chinese need to import to actually blend, to make up and keep a level where they're all right at. Now, clearly, if Chinese steel production also comes down, that's a very large risk to this trade here. But our view is, even in Mongolian supply ramping up, that is merely displacing Chinese production, which is depleting. And either way, the quality of the Chinese material is not the same as the premium Australian quality, which we export. So for that, it's definitely a risk, something we're monitoring closely. But either way, I don't see China going to a net exporter over the next few years. I really struggle to see that. And so even if we're wrong on Chinese continuing to actually require seaborne tons, I don't think they turn into an exporter. And India is a much bigger slice of the pie. Now, I've seen some numbers from different analysts talking by sort of 2035 that India is anywhere between 150 to 250 million tons. Now, this market cannot accommodate that. And I believe those numbers are maybe slightly inflated. But either way, India is coming through. Now, the question is, can they get this from Mongolia, from Russia, from elsewhere? How do you figure out that logistics? And that's a very good question which we're trying to get to the bottom of.
Awesome, Tom. I've just got one last one for you. Maybe as a bit of a teaser for a longer discussion next time. But lithium, are you bearish or bullish? You can keep it relatively brief if you want. We can leave that as a teaser for next time.
Look, the demand side of lithium is very strong. However, the supply comes on and off, and so despite demand being very strong, clearly we're in an oversupplied environment. On our numbers, that oversupply maintains through this year and into next year. I do believe that we're bouncing along the bottom here for the commodity price, and at some point it will turn. However, difficult to get excited, I think, on any developers or earlier stage names in that environment until people can actually really have something to hold on to that the market is turning. So at the moment, we don't have any exposure to the lithium space. I mean, the easy money in the shorts was done. The last couple of years was quite fun there. But I think that easy money's been made. There's clearly trading ranges you could do into some of the producers here. But we're not really constructive in the near term for us to deploy at the moment.
Fantastic. Great to chat, Tom, and thanks for making the time for us.
Thank you very much, guys. Have fun in Indaba.
Rightio, there you go. God, I keep doing outros. I haven't even fucking listened to them yet. But
How good was that, Matty? How good was that?
Oh, mate, I predict sensational.
You predict correct. You know who else is sensational, Matty?
Tell me, JD.
All these guys. MMS, Grounded, Sandvik Ground Support, CRA Insurance, K-Drill, Saltbush Contracting, Swick, Cotro, Cross Boundary Energy, and Hooteroo, Money Miners.
Jeez, that's the quickest that's been done in 3 weeks. Don't forget about your discount for AusIMM underground operators. MOM 100, $100 off the ticket. It's free, $100.
Hooteroo.
Hooteroo.
Free money.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.